Welcome to this video on FinTech policies, standards, and risk management. We will cover an introduction to FinTech and its applications as part of the Postgraduate Diploma in Advanced Computing at ACTS, C-DAC Patna. Our agenda covers two main sessions. Session 18 focuses on FinTech regulations, the role of regulators, standards, and case studies. Session 19 delves into risk concepts, risk management in FinTech and blockchain, and the types and assessment of risk. FinTech regulation is the body of laws and guidelines governing financial technology companies. Its objectives include consumer protection, ensuring market integrity, systemic stability, and balancing innovation while managing risks. Global regulatory frameworks exist across multiple jurisdictions and bodies. In India, key frameworks include RBI Payments Vision 2025 and the DPDP Act 2023. The EU has PSD2 and MiCA, while the US operates under the Dodd-Frank Act and FinCEN rules. Global bodies like FATF and BIS set international standards. Regulators play a vital role in FinTech. Their functions include licensing and registration, establishing rulemaking and guidelines, and conducting supervision and inspection, often utilizing RegTech tools. They also handle enforcement and penalties, maintain regulatory sandboxes for innovation, and facilitate cross-border coordination. FinTech standards and best practices cover three main areas. Security standards include PCI-DSS and ISO/IEC 27001. Operational standards cover ISO 20022 and open banking APIs. Compliance and ethics frameworks focus on KYC/AML. Data governance acts like GDPR, DPDP, and responsible AI principles. The regulatory timeline for India's UPI highlights key milestones. It began with the PSS Act in 2008 and saw the UPI launch in 2016. Later developments include the RBI Ombudsman, the regulatory sandbox establishment in 2019, and the systemic risk response to compliance gaps in 2024. The EU's regulatory evolution includes three major frameworks. PSD2 mandates open banking APIs and strong customer authentication. GDPR emphasizes data minimization and the right to erasure. MiCA, effective in 2024, is the first comprehensive EU crypto law, setting licensing and stablecoin reserve rules. We now begin Session 19, focusing on risk management in FinTech and blockchain. This session will cover core concepts, definitions, types of risks, and various assessment frameworks. Risk is defined as the effect of uncertainty on objectives based on ISO 31000. Key concepts of risk include threat, a potential source of harm, vulnerability, a weakness a threat can exploit, likelihood, impact, and residual risk, which remains after controls are applied. FinTech and blockchain face various risks, including credit risk, market risk, and liquidity risk. Operational risk covers system failures, while cybersecurity risk addresses hacks and phishing. Regulatory risk and smart contract risk are critical, alongside reputational risk from compliance failures. The risk assessment and management framework follows a cyclical process. It begins with risk identification, moves to risk analysis for likelihood and impact, and then risk evaluation against tolerance. This leads to risk treatment, to avoid, mitigate, transfer, or accept, and concludes with continuous monitoring and review. In summary, FinTech requires balancing innovation with stable regulation, exemplified by global standards like PSD2 and MiCA. Effective risk management follows the ISO 31000 cycle, which is essential to address unique challenges posed by blockchain technology.